Hello and welcome to this edition of WealthWise, an education initiative that is brought to you by Baroda BNP Paribas Mutual Fund. I speak to Suresh Soni, who's the CEO of the fund house in this series on various topics. And today we are putting the spotlight on small caps. They have been under the spotlight. A lot of investors, including retail investors, are increasingly doing their SIPs in small caps. At the same time, experts like Suresh, financial planners, constantly keep reminding us that small caps are high risk. So what should, as an investor, you be looking at before you invest in a small cap? Thank you very much, Suresh, as always, for coming by and sharing your vast experience with investors. My first question to you is that, many of us still think that small cap is a very small universe of companies. We've probably been used to terms like penny stocks, etc. But the regulator, SEBI, has made a lot of changes in the categorization, in the classification of companies. So first up, could you, inform investors and our viewers that what is the universe of small cap companies in India?
Sure. Good question. And Vivek, I think this is the first thing that all of us have to understand. See, if you really look at the stock market, the definition of small cap or any market cap for that matter has been defined very clearly by Mutual Fund Association in consultation with SEBI. Top 100 companies of the market by market capitalization are called large cap. Next 150, meaning company number 101 to 250, are called mid cap. And everything else thereafter is called small cap. So we have roughly about 6,000 listed companies, which will mean that the universe of small cap companies would probably be about 5,700 odd after taking out the large and mid cap. Now, what does this market capitalization mean? Typically, the small cap, the largest company in the small cap universe would be about 17,000 market cap at this point of time, which is more than $2 billion. And they are not necessarily the smallest of the companies. The small cap index typically has top 250 companies from small cap, which means 251 to 500. There the market capitalization starts at about 5,500 crores, which is the smallest company. The company number 500 will be 5,500 crores. And the company number 251 will be about 17,000 crores or so of the market cap. Now, this would include a number of companies which are leader in their own spaces. So, for example, the largest shipping company in the country would be a small cap company. The largest wealth management company in the country would be a small cap. Almost all the asset management companies, with the exception of one, would be small cap. So, small cap does not mean poor quality or very small or very tiny companies. They actually start at a market capitalization of about 17,000 crores downwards. But it's a vast universe. The institutions would stop at a certain market cap. And of course, beyond that, you can continue going down to micro cap or penny stock, as you're saying, but that's not the segment that institutions like us would deal in.
That's really amazing the way you've put it, Suresh, that the whole perception and the commentary gets driven by very, very different definitions, I must say, from, the facts that you have put before viewers. My next question, therefore, is that, when we talk of, say, large caps, and you talked about the universe of, say, the top 100 companies by market cap. And if you look at, say, the Nifty, which has 50 large cap companies. So in other words, out of a universe of 100, 50 are covered within, say, the Nifty, and the balance 50 are outside of it. So it's 50-50, half. But, from what I hear you saying, the minute you say small cap, there is a 250 company index, a small cap index. But the number, even if I say the investable companies, I mean, there may be total of more than 5,000, but let's take the case of, say, 2,500 companies that somebody like you and your team would keep an eye on. It's almost 10 times of that lot which is not represented in the index. So, uh, therefore, do you feel that there is a role to play for active fund managers in the whole small cap universe?
Very, very much. I think small cap universe, by definition, when you're looking at large cap investing, typically you look at two parts. You look at allocation and then you look at selection. What do I mean by that? In large cap investing, you typically start with sector allocations, and within that, you choose the stocks. So you may say, oh, I want to be financials 30%, I want to be 15% in IT, or I want to be so much percent in FMCG. Whereas in case of small cap investing, you usually do the other way around. You look at the companies
Hmm.
and then so you look at selection first, and the allocation is a resultant rather than a starting.
Hmm.
Again, just to be very clear, in terms of institutional space, we would probably look at about out of this 5.5, 6,000 companies that are there in the small cap universe. Our hunting range will probably be somewhere in the top 300 to top 500 companies. Beyond that, the market cap become too small. We may not be able to get meaningful exposure, as well as it may not afford us the right liquidity, as well as predictability that we look for.
Hmm.
But that itself is a large number, and therefore it requires a fairly active involvement, both in terms of bottom up research and taking a call on individual companies. See, the difference between the two segments, between large cap investing and small cap investing, is like this. The large cap are typically well established companies who've been around in the business, who are industry leaders in their category, which also will mean that they are somewhat a bit of a mature businesses,
Hmm.
which has both positive and negative. Positive in the sense there is a certain stability in those companies, but at the same time, the growth rate would tend to be a bit moderate. On the other hand, on the small cap companies, because they are starting on a smaller base, the great growth rate can be larger. And if you're able to identify businesses which are strong within that, then you benefit from two sources. You benefit from inherently higher growth rate. That's an alpha. And secondly, also at some point of time, some of these companies would get re-rated and therefore would start commanding much better multiples as you go along. All our IT companies at some point of time were small cap. Now the best of them are among the top leaders in the large cap space. And ditto holds for a lot of other companies as well.
Suresh, would you say that small cap companies tend to be far more volatile, and therefore there is a volatility risk? Of course, as you pointed out, there are pluses and minuses of, there is obviously, you've got to give up some amount of stability and take some risk if you're coming to a more higher growth kind of an opportunity. But from a risk profile point of view, and again, the regulator there has done a great job of, the riskometer. Uh, where does the small cap space sit on the risk parameter?
So I would say equity investing is all about taking risk on the market. The small cap space is not a homogeneous space. And therefore, there could be divergent movement based on the company fundamentals within it because there are companies from very different sectors. So that's one differentiator. Unlike, let's say, a large cap space where there's a lot of index fund and passive fund investing happens, which leads to some kind of a homogeneous movement there. In case of small cap, you don't really find that. So the movements are going to be divergent. Having said that, you are likely to find enough number of good companies, solid companies here, which need not be very volatile. So, somehow we have this conjecture that small cap would be far more volatile,
Hmm.
need not necessarily be there for all the companies there. There would be indeed a slightly higher growth rate and chances of re-rating. which will mean that there will be some companies which may get derated as well. So as much as there could be an upward re-rating, there could also be some derating that can happen sometimes, and which leads to slightly higher volatility compared to the large cap universe. But it doesn't mean that it will be like very much off the chart or something which is very crazy, which the investor will not be able to handle. But our suggestion typically tends to be that this is a segment of the market where you should take slightly longer term view. So I would advise investors to think about it more from 5 year plus horizon. And given the fact that if we are able to identify companies which are growing faster, and on an average small cap companies grow faster than the large cap, you will compound your money a bit faster here. And secondly, there could also be re-rating, which again leads to incrementally better return. So over longer period of time, this is a segment which generates higher return compared to a steady large cap companies. However, it does come with slightly higher volatility.
So would you therefore, and we have in the WealthWise series earlier talked about the importance of SIP with you, Suresh. Would you therefore say that when it comes to a small cap, it is even more advisable to proceed through the SIP route for a far longer period, more than 5 years, as you mentioned?
So I would say if you have a time horizon of longer term, then you can even do lump sum in any equity investment, whether it is large or small, because as long as your time horizon is 5 year plus, you would generally be okay. SIP is a great investment tool because it matches the rhythm of your income with the investment.
Hmm.
And to that extent, it becomes a very easy tool for anybody to adopt.
Hmm.
So the utility of SIP is twofold. One, it kind of gives you a certain amount of discipline. It matches your income flow along with the investment cycle. And finally, it gives you an average price. So SIP is beneficial for sure. One should look at it. But at the same time, if you have a longer time horizon, then allocating lump sum is not a problem as long as you are cognizant of the fact that when I'm investing into equities, I'm willing to live with some amount of drawdown risk
Hmm.
anytime I come into the market.
Hmm.
But if I'm willing to stay ahead, invested for 5 year plus, I would generally be okay.
Suresh, since the categorization by the regulators bases the market capitalization, so, what happens? So, if I've invested in a small cap fund, which has X number of companies, and now one company or two companies move to the mid cap categorization. So, what happens to the investor then?
There are well defined rules around it from the regulator, and I think regulator has done a great job in terms of defining each of the product categories quite clearly. A small cap fund is mandated to invest at least 65% of its money into small cap stocks. Balance 35% can be into large and mid cap, depending upon our view as well as liquidity needs. So even if something is moving from, let's say, small to mid, the stock has done well, the market cap has gone up, you could always look for buying some other small cap and then maintain that allocation.
One final question, Suresh, before I let you go. Who should be investing in a small cap fund? In the sense that, by the very definition, these are companies, of course, you made the point that they're very diverse. 17,000 crore is a very big amount. We celebrate a unicorn in the startup world. These are, multiple versions of that. But on the one hand, we say that, when you're young, you should be looking at a long-term goal, like say your retirement, like say your children's education, etc., etc. So, at what stage should a person? Yet there are many people who say that start your investing journey with an index fund or a balanced advantage fund, and only then get into a more equity specific scheme. Given your vast experience, you started out when the mutual fund private sector was just taking off in this country. uh, what is your view? Who should invest in a small cap fund?
So I would say every one of us should allocate some part of our equity portfolio to small cap. This is a segment of the market which grows at faster than the broader industry growth rate and therefore compounds your wealth faster than what the large caps would generally do. If I were to give you just broad picture of India's market capitalization, about 65 to 70% of a market capitalization is in the large cap, and balance about a third would be between mid and small cap, around half and half between them. So if you want to mirror the broad market, then maybe 15-20% allocation of your equity portfolio goes into small cap. If you have a longer time horizon, then you can extend it a little more because you are willing to, let's say, take a little bit volatility risk, but want compounding at a faster clip. So then you might want to extend it to, let's say, 25-30%. So somewhere between, depending upon the investor's risk appetite, anywhere between 10 to 30% of the portfolio is what I would say could be looked at for this segment of the market.
Always a pleasure talking to you, Suresh. Thank you very much for, as usual, explaining something so simply and so nicely. Thank you. A pleasure talking to you as always.
Wonderful, Vivek. Always great talking to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.